Warren Buffett, often referred to as the Oracle of Omaha, is a name synonymous with success in the world of investing. His journey to becoming one of the wealthiest individuals in the world has been marked by brilliant decisions, deep understanding of business fundamentals, and, perhaps most importantly, patience. One of the most iconic investments in his career was his purchase of Coca-Cola in 1988, a move that solidified his reputation as a master investor. But how did Warren Buffett, a value investor known for seeking out undervalued companies, come to buy one of the most recognized global brands in the world? The story begins years before he made the famous purchase, with a deep connection to Coca-Cola's story and the company's position in the market at the time. Buffett's affinity for Coca-Cola dates back to his childhood. He recalls drinking Coca-Cola at the age of 6 and even used the beverage as a part of his early entrepreneurial endeavors. Buffett would buy a bottle of Coke for 5 cents, sell it for a penny more, and pocket the difference. This simple act, which might seem like a mere child's game, laid the groundwork for Buffett's deep understanding of Coca-Cola's potential as a business. By the time the 1980s rolled around, Warren Buffett was already a respected figure in the world of finance. He had built his fortune by investing in undervalued companies, including the likes of See's Candies and Geico. Buffett's philosophy was rooted in the idea of buying businesses that had strong competitive advantages and were capable of generating consistent earnings over the long term. Coca-Cola, with its global presence and iconic brand, fit this model perfectly. However, when Buffett first began looking at Coca-Cola as a potential investment, the company was far from the dominant force it is today. While Coca-Cola was undeniably a well-known brand, it had experienced some challenges. The company had faced pressure from competitors like Pepsi, and in the early 1980s, Coca-Cola was in the midst of a significant shift in its leadership. There were concerns about the company's ability to maintain its market share and continue its growth trajectory. But Buffett saw something others didn't. He understood that Coca-Cola's true value lay not in its short-term struggles but in its long-term potential. The brand had a unique advantage in its global recognition and the loyalty it commanded among consumers. Coca-Cola wasn't just a soft drink. It was a cultural icon. To Buffett, this was exactly the kind of company that could generate steady profits for decades to come. Buffett's interest in Coca-Cola grew as he researched the company further. He learned that Coca-Cola had a solid track record of profitability, a vast distribution network, and a product that had become embedded in the fabric of society. But what truly captured his attention was the company's global reach. Coca-Cola was available in virtually every corner of the world, and its brand was recognized by billions of people. In an era where brand recognition and consumer loyalty were becoming increasingly important, Coca-Cola was a company with unparalleled potential. Despite these appealing factors, Warren Buffett didn't rush into buying the stock. He took his time, carefully analyzing the company's financials and evaluating its competitive advantages. But in 1988, after weeks of research and reflection, Buffett decided it was time to make a move. In the world of investing, the ability to recognize an opportunity and act decisively is a rare skill. Warren Buffett's decision to invest in Coca-Cola in 1988 was a prime example of his ability to recognize the long-term value of a business. However, it wasn't a decision made in haste. Buffett's approach to investing is methodical, and the Coca-Cola investment was no exception. By the late 1980s, Warren Buffett was already the chairman and largest shareholder of Berkshire Hathaway, the investment firm he had transformed into a powerhouse. Berkshire Hathaway had made a name for itself by acquiring undervalued companies with strong fundamentals and competitive advantages. Buffett had built a reputation for his disciplined, value-based approach, and his reputation was only growing. Before Buffett made the move to buy Coca-Cola, he had spent considerable time studying the company. He wasn't just interested in the brand's potential or its products, he was also keenly focused on the financial health of Coca-Cola. He wanted to understand the company's earnings growth, cash flow, and the consistency of its operations over time. One of the key elements that attracted Buffett to Coca-Cola was its predictable revenue stream. Coca-Cola wasn't a company that would experience sudden swings in demand or sales. The brand had an established customer base and a history of steady sales growth. Coca-Cola's global reach combined with its consistent profitability made it a prime candidate for Buffett's investment strategy. But the deciding factor, perhaps, was the fact that Coca-Cola was a business with a moat. In Buffett's terminology, a moat is a competitive advantage that protects a company from the threats posed by competitors. Coca-Cola's moat was its powerful brand, its vast distribution network, and its ability to maintain its market dominance in the face of increasing competition. This made Coca-Cola a perfect fit for Buffett's philosophy of investing in businesses with sustainable advantages. Despite his confidence in Coca-Cola's potential, Buffett wasn't willing to make an impulsive decision. He continued to monitor the stock, observing the company's performance and waiting for the right moment to strike. And in 1988, that moment arrived. At the time, Coca-Cola's stock was trading at about $40 per share. Buffett had already amassed a significant amount of cash in Berkshire Hathaway's portfolio, and he was looking for an opportunity to deploy it. Coca-Cola's stock was not undervalued in the traditional sense. There were no signs that the company was in distress or undervalued by the market. However, Buffett believed that the company's future earnings growth would far exceed its current valuation. In May 1988, Buffett made the decision to purchase 7% of Coca-Cola's stock for $1.02 billion. This was a massive purchase, but for Buffett it was a logical step in his strategy of acquiring businesses with strong fundamentals. At the time, the purchase represented one of Berkshire Hathaway's largest investments. Buffett was so confident in Coca-Cola's future that he was willing to pay a premium for the stock, believing that the long-term benefits would far outweigh the short-term costs. Buffett's decision was met with some skepticism. Many analysts at the time questioned whether Coca-Cola's growth prospects justified such a significant investment. The soft drink industry, they argued, was already mature, and it was unclear how much further Coca-Cola could expand its market share. But Buffett's faith in the company's brand, its global presence, and its ability to generate consistent earnings was unwavering. When Warren Buffett made the bold move to purchase a 7% stake in Coca-Cola in 1988, the news sent shockwaves through the financial world. While Buffett's reputation as a successful investor had been well established, many market analysts were curious about why he was willing to pay such a premium for a company that, on the surface, seemed to have limited growth potential. Coca-Cola, after all, was not a startup or a tech company. Its business model was straightforward, based on selling beverages. Despite the skepticism, Buffett's confidence in his decision was unshaken. And in the years that followed, the wisdom of his investment would become apparent not only to the market but also to Coca-Cola's leadership team. The company, at the time of the purchase, was undergoing significant changes in leadership, and the decision by Buffett to invest was welcomed by some as a vote of confidence in the company's future. The market's reaction to Buffett's investment in Coca-Cola was one of intrigue. In the short term, Coca-Cola's stock price saw a modest increase, but it wasn't until the years that followed that the real value of Buffett's decision became evident. The key to Coca-Cola's future success wasn't just about short-term stock price fluctuations, it was about the company's ability to continue to expand its global reach and build on its iconic brand. At the time, Coca-Cola was under the leadership of Roberto Goizueta, the CEO who had taken over the company in 1981. Goizueta was a visionary leader who had already made some bold moves, including introducing the new Coke formula in 1985, though this would later be deemed a misstep. However, under his leadership, Coca-Cola had also managed to build a stronger global presence and refine its business model. Goizueta's focus was on growth, both in established markets and emerging ones. Goizueta recognized the importance of Buffett's investment in Coca-Cola, and the relationship between the two men would evolve over time. While Buffett was a passive investor in the sense that he did not seek to influence day-to-day operations at Coca-Cola, his investment provided the company with additional credibility. Goizueta understood that the endorsement of someone like Warren Buffett, who was known for his careful, disciplined approach to investing, was a powerful asset for Coca-Cola, especially during a time when the company was working to strengthen its position in the global market. In fact, Buffett and Goizueta would later develop a strong mutual respect. The two men shared similar views on business, both believed in the power of a strong brand, the importance of maintaining a long-term perspective, and the necessity of sticking to what one knows. Over time, Buffett's relationship with Coca-Cola became more than just that of an investor and a company. It became a partnership based on shared values and an understanding of what made the business successful. Buffett's investment also gave Coca-Cola a certain level of stability during a time of corporate upheaval. The company was dealing with intense competition from PepsiCo, which was launching aggressive marketing campaigns to win market share in both the U.S. and international markets. However, Coca-Cola had one key advantage that its competitors could not easily replicate: its global reach. Coca-Cola was available in nearly every country in the world, and its brand was recognized in both urban centers and rural villages alike. This was something that Buffett, with his deep understanding of business, saw as an enduring advantage. Coca-Cola's position as a global brand was not just a reflection of its past success but also a foundation for its future growth. Buffett understood that the more people who drank Coca-Cola, the stronger the brand would become and the more valuable the company would be. As the years passed, Warren Buffett's investment in Coca-Cola proved to be a masterstroke. From 1988 onwards, Buffett's stake in the company grew not only in value but also in significance. By the early 1990s, Coca-Cola was undeniably one of the most successful and influential companies in the world, and its future looked incredibly bright. Buffett's patience and long-term perspective were paying off handsomely, reaffirming the wisdom of his investment approach. In 1994, Berkshire Hathaway increased its stake in Coca-Cola to 9.4%, solidifying Buffett's position as one of the largest shareholders of the company. At the time, Coca-Cola's stock was trading around $40 per share, and the company had begun to show signs of robust growth in international markets. For Buffett, the decision to buy even more shares was an easy one. He saw Coca-Cola not just as a successful company but as a business with staying power, a business that could keep generating profits and cash flow for decades. Buffett's philosophy of buying a great company at a fair price had always guided his decisions. When he purchased Coca-Cola, he wasn't concerned with short-term market fluctuations or quarterly earnings reports. He was looking at the big picture. Coca-Cola was a business that had a powerful brand, strong market position, and a vast distribution network. This was a company that could weather economic downturns and capitalize on growth opportunities for years to come. By the late 1990s, the world's economy was entering a period of significant change. The internet boom had begun, and new technologies were reshaping industries across the globe. Despite the rapid advancements in technology, Buffett remained steadfast in his commitment to the companies he had invested in, including Coca-Cola. Unlike many of his peers who were jumping into the tech sector with the hopes of capturing the next big thing, Buffett stuck to his principles. He continued to focus on companies that had a proven track record of success, strong fundamentals, and sustainable competitive advantages. In Coca-Cola, Buffett saw all these qualities. The company had successfully navigated the challenges of the 1980s and 1990s, which included the pressures of global competition and changing consumer preferences. While PepsiCo was still a formidable competitor, Coca-Cola had an unrivaled global presence and a loyal customer base that provided a solid foundation for future growth. One of the key decisions that helped Coca-Cola's long-term success was its ability to expand into emerging markets. As the global economy grew, new markets in Asia, Africa, and Latin America became critical to Coca-Cola's strategy. The company's ability to adapt to different cultures and create localized marketing strategies played a significant role in its expansion. Buffett recognized that Coca-Cola's reach in these markets would be a major driver of growth for years to come. By 2000, Coca-Cola's stock had appreciated significantly from the price Buffett had paid for it in 1988. The company was not only a cash cow for Berkshire Hathaway, but it had also become a symbol of Buffett's investment philosophy, a shining example of the power of buying great companies and holding onto them for the long term. The returns were staggering, and Buffett's commitment to Coca-Cola paid off in ways that few could have predicted when he made the initial investment. But for Buffett, the success of Coca-Cola wasn't just about financial returns. It was also about the relationships he had developed with the company's leaders, especially with Roberto Goizueta, the CEO. The two men had formed a bond of mutual respect. Goizueta recognized Buffett's wisdom and appreciated his approach to business. In return, Buffett admired Goizueta's vision and leadership. By the early 2000s, Warren Buffett's investment in Coca-Cola had become legendary in the world of finance. What had initially been a bold $1 billion investment in 1988 had grown into a multi-billion-dollar stake in one of the world's most iconic companies. But more importantly, it had reinforced the fundamental principles that Buffett had always preached: patience, discipline, and the power of investing in businesses with long-term competitive advantages. Even as market trends shifted and new industries emerged, Buffett never wavered in his commitment to Coca-Cola. While other investors chased the dot-com boom in the late 1990s and early 2000s, Buffett stayed true to his investment philosophy, holding on to his shares and continuing to reap the rewards of Coca-Cola's consistent performance. His ability to ignore market noise and focus on the intrinsic value of a company was a testament to his brilliance as an investor. One of the key reasons Buffett's investment in Coca-Cola continued to thrive was the company's aggressive international expansion. By the mid-2000s, Coca-Cola was earning nearly 80% of its revenue from outside the United States. The company had successfully positioned itself in emerging markets like China, India, and Brazil, countries where the middle class was growing rapidly, leading to increased demand for global brands. Buffett had understood from the beginning that Coca-Cola was not just a U.S. company. It was a global powerhouse, and its potential was limitless. Coca-Cola also had another powerful weapon in its arsenal: brand loyalty. Unlike tech companies, which could be disrupted by new innovations, Coca-Cola's appeal was timeless. People of all ages and backgrounds continued to drink Coke, and its advertising campaigns ensured that the brand remained as relevant in the 21st century as it had been in the 20th. Buffett often said that Coca-Cola's brand was so strong that customers would keep buying it even if the price of a bottle increased slightly, an indication of pricing power that few companies possessed. From a financial perspective, Buffett's investment in Coca-Cola turned out to be one of the greatest success stories in the history of investing. He had purchased the shares at an average price of around $3 per share, adjusted for stock splits. Over time, the value of those shares skyrocketed, with Coca-Cola's stock price growing more than 20 times since his initial investment. But beyond the stock price appreciation, Coca-Cola became one of Berkshire Hathaway's most reliable sources of dividends. The company had a strong track record of increasing its dividend payments, meaning that year after year, Buffett and Berkshire Hathaway were earning more and more money simply by holding onto their shares. By 2020, Berkshire was collecting over $700 million in dividends annually from Coca-Cola alone without selling a single share. This was the essence of Buffett's investing strategy: buy great businesses and let time do the work. Buffett's investment in Coca-Cola was not just about making money. It was about demonstrating to the world the power of long-term investing. In an era where many investors focus on short-term gains and rapid trading, Buffett showed that patience and discipline could lead to extraordinary results. His Coca-Cola investment became a symbol of his philosophy: find a great business, buy it at a fair price, and hold onto it for decades. To this day, Buffett considers Coca-Cola one of his favorite investments. He often speaks about how he still drinks 5 cans of Coke a day, reinforcing his deep personal connection to the brand. His unwavering belief in the company has made Coca-Cola a permanent fixture in Berkshire Hathaway's portfolio, proving that great businesses never go out of style. Warren Buffett's decision to buy Coca-Cola in 1988 was a defining moment in his career. It showcased his ability to recognize a great company when others doubted its growth potential. Over the decades, Coca-Cola has continued to thrive, and Buffett's investment has turned into one of the most profitable moves in financial history. For investors, the lesson is clear: true wealth is built over time. By focusing on companies with strong brands, durable competitive advantages, and consistent earnings, anyone can follow in Buffett's footsteps and achieve long-term financial success. The Coca-Cola story is not just about one investment, it's about a timeless approach to building wealth. Even today, as markets fluctuate and new investment trends emerge, Buffett's Coca-Cola investment stands as a shining example of why the best investors are not those who chase the latest fads, but those who recognize value and have the patience to let it grow.